Assalamualaikum and good morning everyone. My name is Nobalisra binti Suhaimi. My matrix number is 01D8019F1061.
Assalamualaikum and good morning everyone. My name is Najwatul Hadira binti Muhammad Azmin and my matrix number is 01D8019F1111.
Assalamualaikum. My name is Ehsan Hatimi bin Amiruddin. My matrix number is 01D8019F1051. Today I will present about the topic on hand, which is assurance and non-assurance related. The American Institute of Certified Public Accountants (AICPA) Special Committee on Assurance Services defines assurance services as independent professional services that improve the quality of information or its context for decision makers. Types of assurance. Firstly, special purpose audit. Next, assurance level for related services. Due diligence review. Finally, forensic audit. The special purpose audit. Among the types of engagement that can be categorized as special purpose audit are audits of financial statements prepared on an other comprehensive basis of accounting, OCBOA, audits of specified element, accounts, or item, compliance with contractual agreements, and summarized financial statements. The reporting standard to be used for this type of engagement is the ISA 800, which has the objective to address appropriately the special considerations that are relevant to the acceptance of the engagement, the planning and performance of the engagement, and forming an opinion and reporting on the financial statements. Among the general considerations which accountants need to consider as highlighted in the standards are: should have an agreement with the clients. The auditor should ensure there is an agreement with the clients as to the exact nature of the engagement and the form or content of the report to be issued. Next, clear understanding in planning of the purpose and the uses of information being reported. In planning audit work, the auditor should have a clear understanding of the purpose and the user of the information being reported. After that, make appropriate changes if auditor is requested to report in a prescribed format. When the auditor is requested to report in a prescribed format, the auditor should make appropriate changes to conform with the requirement of the auditing standards. Lastly, significant interpretation of agreement should be disclosed. When reporting on information which is based on provision of an agreement, the auditor should consider whether any significant interpretation of the agreement are clearly disclosed in the financial information.
Today I am going to explain about the due diligence audit and the forensic audit. Due diligence is an investigation, audit, or review performed to confirm facts or details of a matter under consideration. It can be categorized as either assurance or non-assurance engagement due to the wide range of matters and may or may not require a professional opinion. This engagement represented by the issuance of an engagement letter. Due diligence involves examining a company's numbers, comparing the numbers over time, and benchmarking them against competitors. The report issued usually contains a restriction on the purpose. Next is the forensic audit. The purpose of audit forensic is to obtain or develop information as legal evidence or for use by expert witness in court cases. Forensic audit is used to uncover criminal behavior such as fraud and embezzlement. Forensic auditing requires critical analysis and investigative skills integrated with accounting knowledge and business experience. There is a few stages of forensic auditing, which is accepting the assignment, which requires a letter of engagement, planning the work, gathering evidence, reporting, and court proceeding. Now I will call upon Nurwal Yusra to continue our presentation. Thank you.
The level of assurance provided by the professional accountant conclusion should convey the degree of confidence that the intended user may place in the credibility of the subject matter. The IAASB identified two levels of assurance that can be provided: reasonable assurance and limited assurance. Reasonable assurance is a high level of assurance regarding material misstatement. Reasonable assurance includes the understanding that there is a remote likelihood that material misstatement will not be prevented or detected on timely basis. To achieve reasonable assurance, the auditor needs to obtain sufficient appropriate audit evidence to reduce audit risk to an acceptably low level. This means that there is some uncertainty arising from the use of sampling, since it is possible that a material misstatement will be missed. Reasonable assurance is important because it gives direction on the valuation of the soundness and dependability of the financial reports by auditors. It also demonstrates the effectiveness of internal control by management and internal audits by internal auditors. Reasonable assurance also helps in examining the auditor's carelessness and liability. But somehow, auditors cannot achieve absolute assurance because of the various factors that limit and hinder the auditing process. Factors affecting reasonable assurance: inherent limitation of an audit. For example, failure of audit procedure to detect material misstatement in financial statement because of the use of testing such as application of procedure on samples, or the inherent limitation of accounting and internal control system, and persuasive nature of audit evidence rather than conclusive. Next, exercise of judgment by the auditor in gathering evidence and forming conclusion. Lastly, existence of other limitations like related parties. Accordingly, because of the factors described above, an audit is not a guarantee that the financial statements are free from material misstatement, because perfect assurance is impossible to achieve. Furthermore, an audit opinion does not assure the future viability of the entity or the efficiency or effectiveness with which management has conducted the affairs of the entity. Limited assurance: the practitioner collects less evidence than in a reasonable assurance, but enough to express the practitioner's view in a negative way. Normally, the practitioner accomplishes this by doing fewer or different tests than are required for a reasonable assurance, or by using smaller sample size for the tests performed. A limited assurance performs fewer procedures than a reasonable assurance. Firstly, by reducing the number of items to be examined. For example, by reducing sample sizes for tests of details. Next, performing fewer procedures by performing only analytical procedure in circumstances when in a reasonable assurance, both analytical procedure and tests of detail would be performed. Or lastly, performing procedure on location at fewer facilities. In addition, when undertaking analytical procedure in a limited assurance, the assurance practitioner may use data that is more highly aggregated. For example, data at regional level rather than at a facility level, or monthly data rather than weekly data, or use data that has not been subjected to separate procedure to test its reliability to the same extent as it would have been for a reasonable assurance. A review engagement is also known as a limited assurance or a negative engagement. Auditors conduct a review engagement after an accountant completes an audit of a company financial statements, and therefore, the auditor provides limited assurance on the accuracy of the financial statement. During the engagement, the auditor performs inquiry and analytical review procedure to provide a moderate level of assurance required to provide a negative assurance report. In a negative assurance report, the auditor states whether they found anything that caused them to believe that the assertions of one party does not present a true and fair view. The auditor is required to disclose if they encountered any information during engagement that caused them to believe that the financial statements do not present a true and fair view of the company or the financial statements do comply with the specific accounting standards. A review engagement differs significantly from an audit engagement since the former provides less assurance to the intended user. This engagement is designed to allow auditors to express limited assurance that the financial statements are in accordance with approved accounting standards. However, even though limited assurance is provided, the auditor performing the review must remain independent of the client. The review procedure suggested must include obtain knowledge of the accounting principles and practice of the client industry. Next, obtain information of the client such as the client business environment. Next, make inquiries of management, perform analytical procedure, and lastly, obtain a letter of presentation. The following are the main parties in a review engagement and the roles they play in the process. Firstly, management. The management is responsible for preparing the main financial statement, such as balance sheet, income statement, and cash flow statement, in accordance with the financial reporting framework. Also, the management is required to implement internal control system to help in preparing financial statements that are free of material misstatement. They should also provide the relevant financial data to help the accountant prepare the financial statement in a timely manner. Secondly, practitioner. The individual performing a review engagement must be a licensed practitioner. The practitioner is required to obtain evidence thoroughly rather than rely on evidence provided by the third party. He or she must also perform procedure to reach a conclusion of whether anything came to their attention that caused them to believe that the financial statements are not prepared in accordance with the applicable financial reporting framework. Intended users. The intended users of the financial statements can be shareholders, investors, and creditors. The review engagement is conducted with the goal of enhancing the user's confidence in the financial statements. Since the financial statements have already been audited and certified, the auditor's role is to provide negative assurance on whether the review financial statements comply with the applicable reporting standards and whether they are free from material misstatement. The financial statements are considered materially misstated if they contain errors, fraud, or omissions that can potentially influence the user economic decision. That's all from us. Thank you.